manufacturing activity in most Asian economies weakened in the month of March, dragged by cooling global demand. Now, Purchasing Managers Index data for factories across Asia paints a worsening picture, one that's expected to weigh on the region's recovery and keep policymakers on their toes. China led the slide with its PMI unexpectedly easing to 50 from February's 51.6. Now, export-reliant Japan and South Korea both saw manufacturing activity shrink. India's PMI was an outlier, showing more resilience. Its March reading jumped further into expansion territory to 56.4 from February's 55.3. Remember, a PMI reading above 50 signals expansion, while a figure below 50 indicates contraction. Now, to talk more about the slowing March factory activity across Asia, we're joined by Steve Cochran. He's Chief Economist for Asia Pacific at Moody's Analytics. Steve, good to have you with us. What does the latest PMI data tell you? I mean, would it be fair to say that China's reopening isn't having much of a positive impact on Asia?
Well, I think what it's telling us is that the rebound of the economy in China is going to be more of a domestic-led, services-led recovery than led by manufacturing. It's something we expected. I mean, we know that demand for exports to Europe and the U.S. and elsewhere is very weak. We've seen a downturn in exports really since the fourth quarter of last year. Exports out of China and then exports out of Southeast Asia and elsewhere have been very weak as well. Also, the PMI numbers for January and February were remarkably strong for China, but that reflected the really quick opening up and turnaround after the pivot away from zero COVID back in December. It was kind of hard to imagine that they would stay as high as they did, and those PMI numbers did, as you mentioned, came down for the month of March. Particularly the export orders figure went down almost to 50. Total orders up a little higher, which means that domestic orders were stronger than export orders. And again, that illustrates the strengthening of the domestic economy. Also, the employment component of the China PMI actually was the one figure that came down just below 50. So I don't think we can expect that manufacturing is going to do a whole lot to add jobs in the near term in China, just kind of hold steady. I think it's going to be the service side of the economy that provides employment gains really through the rest of at least the first half of this year.
So you're saying 2 good months for PMI in China, 1 not so good month. So is it too soon for Asian factory activity to pick up on the back of China's reopening?
It is a little too soon, I think. The demand is not really going to be there, and it probably won't be there until the Chinese economy continues to ramp up into the second half of the year. I think we have to see a couple of things. One is we have to see the property development sector in China get back on its feet. There are some signs that construction activity is accelerating as some liquidity is being pumped into some of the larger property developers in China. That's a good thing. It creates a lot of demand for commodities, both basic commodities and manufactured commodities, both internally manufactured but also imported as well. That will be one driver of manufacturing growth in the region. And then a further pickup in terms of the domestic economy and the export economy all around the world, particularly, again, demand for goods from Europe and the U.S., which will feed through China, create demand for intermediate goods that come out of the rest of Asia.
Why is India such a standout? Are you positive about factory activity there?
India really does look like it's behaving quite differently. I think one thing, it's important to realize that the second half of last year was a very weak period for India. There was either a no growth or a little bit of a decline, actually, in the third quarter and fourth quarters of last year. And only now does the economy in India seem to be picking up. One of the factors about the Indian economy is it is not so closely tied to global trade as is China and as the rest of the Asia-Pacific region. It's more driven by its own domestic economy. Domestic demand is picking up coming out of a weak couple of quarters in 2022. And also investment spending seems to be picking up in India as well. So investment spending leading to production demands for capital goods and capital equipment in particularly is one reason why the industrial production index looks so strong in India. I do still think that India has a ways to go as well. Another benefit to India is that it is acquiring rather inexpensive oil from Russia, and that helps the manufacturing process helps for it to continue to grow without the impediment of higher energy prices.
And now there's other headwinds as well in our business headlines, rising oil prices. Now, if oil prices stay high for another month or so, how would that actually affect Asian factory activity?
Yeah, this was a surprise last couple of days as we saw oil pick up as OPEC announced a production cut, and immediately prices picked up in expectations of a limited supply. Now, Brent crude, the international benchmark for crude oil, is about $85 a barrel. It was as low as about $72 a barrel back in the middle of March. That was remarkably low, however, and that low point was driven to a good degree by the timing of the banking crisis in the U.S. That's when the news first came out. And there were a lot of expectations that the banking crisis might be that one next step towards a recession. And there was a lot of a downward pressure on oil prices with the expectation that demand would be weak. That hasn't happened so much yet. And also, it's important to realize that in the Gulf region anyway, Gulf energy producers really do want to see the price of oil at some kind of a sweet spot, $80 to $85 a barrel. That's high enough to cover revenue projections, but not too high to take the global economy into a recession. It would take more than $85 a barrel to put the global economy into recession. We've actually been expecting that oil prices would go up, not so much because of a production cut, but because of the ramping up of the Chinese economy is going to generate demand for more oil. We still expect that to be the case. So we probably will see oil rise at least to $90 a barrel, maybe a little bit above that. That still is at a level which, as long as everything else goes right in the global economy, in and of itself would not be enough to push the economy into recession.
Steve, we've run out of time. Thank you for the analysis. That's Steve Cochran. He's Chief Economist at Asia Pacific for Moody's Analytics.